Higher OPEC production levels and price cuts from Saudi Arabia are weighing on the price of oil, but our featured guest today says the bigger issue is whether fears about slowing economic growth will outweigh concerns we have about the conflict in the Middle East. Joining us now to discuss is Bart Melek, Global Head of Commodity Strategy at TD Securities. Bart, always great to have you back on the program.
It's great to be here. Happy New Year, everyone.
Happy New Year to you. Indeed, we have some big issues to talk about, but I want to talk about just briefly about the here and now. I'm taking a look at the price of crude at the start of the week. It's down substantially. It's Saudi Arabia, price cuts. What's going on in the market right now?
Well, I think today in particular, it's a reaction to Saudi Arabia dropping prices for its crude that it is supplying. Now, the worry, of course, in the market broadly is, and when you look at the CFTC data, that investors have reduced long exposure and have tilted towards the short end of exposure on crude oil. They're worried that we will get a significant slowdown in demand as the year unfolds, and that, of course, is due to the restrictive monetary policy lagged effects and its impact on the economy. Though we haven't really seen that occur to a great extent, but the concern is certainly out there. The other big worry is that U.S. supplies continue to surprise to the upside, and of course that OPEC report showed that the cartel produced some, I think, 70,000 barrels more at the end of the year, the last month of the year, than I think people expected. And now, of course, there is worry that perhaps they may not be as committed to future cuts. There is talk that they will extend potentially to the end of the year. But if you're seeing production move higher at a time where you're worried about less demand and U.S. production still going strong, you may, just as a matter of course, take whatever profits you might have had or try to reduce losses and see what happens. And in the meantime, we continue to have, multi-decade increase in risk in the Middle East. We're continuing to see problems in the Red Sea. We now have potentially two navies facing off each other. I'm talking about potential problems between the Iranians and the American fleet. I'm not saying that's going to happen, but certainly there's the risk. We are worried about the extension of the current Israeli conflict, beyond where it currently is, involving maybe rest of the region, which could logically impact supply of oil over the next few months. That, in my opinion, has not really been priced in, and the market is very, I would judge, dismissive of those risks at this point.
Is that the longer term thing that we have to start thinking about? Is the dynamic? We're very early into 2024. We have some here and now issues before us, but over the holidays, the only headlines I saw came out of the Middle East were concerning headlines. So it's surprising to come, back to the office and find crude down. Longer term, do we need to be thinking about these geopolitical pressures?
Absolutely. I think we also have to be thinking about what OPEC will do, and thinking about what demand actually looks like for 2024. In our estimate, we're looking at demand to still grow about 1.2 or so million barrels a day for the year. And I'm quite confident that at the next OPEC meeting, Saudi Arabia and the rest of the cartel will commit to extending the cuts, and they'll come to some sort of accommodation to keep supply from overwhelming the market. We project, maybe a balanced market in the first 3 months of this year. I was very tempted to say next year, but we're in 2024
we're
right now.
Here. We flipped the calendar.
We do see substantial deficits for the balance of the year, certainly for the next 6 months or so, if OPEC does commit and execute. And we're not all that confident that the very strong pace of production increases from U.S. shale is going to continue. When we look at CapEx, that has moderated. And I don't think the price environment is probably conducive to as much activity as we've seen last year. And if that's the case, then I think OPEC's ability to move prices higher will be successful, probably into the second quarter of the year.
Let's talk price then. I mean, with the pullback we're seeing right now, I'm a little over $70 a barrel for West Texas Intermediate on my screen. Where could we see oil prices later this year if some of those factors can play out?
We've been formally saying that mid 80s or so for WTI, a little higher for Brent here is very possible, but we're going to have to get off the we're going to have to inflect higher here. We're going to have to start talking about a potential recovery and when that might be, as opposed to just entering a trough on the macro side. And I think we're going to need a bit more timing specificity on when the Fed is likely to ease, because we've been going back and forth on that front here. The market is probably a lot more optimistic with regards to when the Fed is going to cut and how much they're going to cut than the Fed itself. And we're seeing, over the last few days, we've seen some adjustment where the market has been pulling back, where on the equity side, and I'm not projecting equities, but I think the expectations have grown a little less, and the implication for markets like oil and broader commodity markets is here that when that risk appetite wanes a little bit, it impacts my market as well. So it's all very much interconnected. Interest rates, risk appetite for equities, and of course commodities respond within that framework.